Chapter 3 focuses on how to use a form known as a T account to record our different types of business transactions. You ready? Let's go. So the T account is called a T account because it is shaped like a T. Okay, no more jokes. So every account title will have its own separate T account. So if you have 10 different type of assets, you're going to have 10 separate T accounts because every account title has its own separate T account. So across the top of the T account, you will list the heading or the account title, whether it is cash, account receivable, supplies, equipment, accounts payable. You get the point. Each account title has its own separate T account, and you only have one T account for each account title. Now, there are two sides of the T account. You have the left-hand side of the T account, and you have the right-hand side of the T account. The left-hand side of the T account is known as the debit side. So in accounting, the term debit simply means left-hand side of the T account. Again, debit refers to the left-hand side of the T account. The right-hand side of the T account is known as the credit side of the T account. So in accounting, the term credit refers to the right-hand side of the T account. So if you're asked to debit a transaction, that means record it on the left-hand side of the T account. If you're asked to credit a transaction, that means record it on the right-hand side of the T account. Okay? So again, debit means left-hand side of the T account. The word credit refers to the right-hand side of the T account. Now, there are certain types of accounts that increase on the debit side, while other accounts increase on the credit side. It is contingent upon the account classification, meaning is the account an asset account, a liability account, or an owner's equity account. That would determine if the account increases on the debit side or if the accounts increase on the right side. Okay? So here we have what's known as the rules of debits and credits. The rules of debits and credits. Remember that accounting is a rule-based profession. We have the GAAP principles, and these rules tell us how to record our different types of business transactions. Let's get right into these rules, beginning with the assets. To make the rules seem a little simpler, think about the account equation that says assets equal liabilities plus owner's equity. Think about the assets are on the left-hand side of the account equation. Assets increase on the left-hand side or the debit side of the T account. Liabilities plus owner's equity, they are on the right-hand side of the equation. Liabilities and owner's equity both increase on the right-hand side or the credit side of the T account. So focus on what side of the account will make the account increase. Again, assets increase on the left-hand side of the T account. liabilities and owner's equity, they increase on the right-hand side of the T account. If you know what side of the account will make the account increase, then the accounts must decrease on the opposite side of the T account. Now, do not overthink this. Your job is to follow the accounting rules. So to you, it may not make sense that assets increase on the debit side, but accounting again is a rule-based profession. Therefore, you must follow these rules when recording your different types of business transactions. So here I've expanded the account equation to include our drawing account, revenue accounts, and expenses. And these are the accounts that increase the owner's equity section of the account equation. So I want you to think about this. Think about how these accounts impact owner's equity. Again, focus on how these accounts are going to impact your owner's equity. For example, we know that capital and revenue, they both increase owner's equity. Therefore, your capital and revenue accounts increase on the credit side because an increase in revenue or in capital will increase your total owner's equity. Whereas a withdrawal or expenses, they will cause a decrease in your total owner's equity. Therefore, drawings and expenses increase on the debit side because an increase in withdrawals or expenses will decrease your total owner's equity. So these rules may seem a little overwhelming. My job is to make the rules simpler. So I'll develop what we call a mnemonic to help you remember the rules of debits and credits. So you ready? Our first mnemonic is called DADE, D-A-D-E. These are the types of accounts that will always increase on the debit side. And I forgot to mention normal balance. When it talks about an account's normal balance, it's referring to the side of the account that will make the account increase. So these type of accounts will always have, they always increase on the debit side. The debit side is their normal balance side. The A stands for assets, second D stands for drawing, the E stands for expenses. So DADE shows the types of accounts that have a normal balance on the debit side, which means they increase on the debit side. For your credit side increases, we have accounts such as capital account, liability account, and your revenue account. These type of accounts will always increase on the credit side. The credit side is known as their normal balance side. So focus on the positive. What side of the account will make the account increase? If I know the account's increase side, then I know the account will decrease on the opposite side of the T account. So now that we have looked at the rules of debits and credits, let's practice using a T account to record our different types of business transactions. For our first transaction, we have the owner withdrew money from a personal savings account to deposit into a new business checking account. So first you want to identify which accounts will be involved in this transaction. The accounts involved will be cash and Eli capital account. Okay? Now ask yourself, are the accounts increasing or decreasing because of this transaction? Well, because of this transaction, there would be an increase in the cash account and an increase in the capital account. Next, determine what are the account classification. Cash is an asset account and capital falls up under owner's equity. Now you're ready to apply the rules of debits and credit. Cash is an asset. Assets increase on the debit side. Capital falls up under owner's equity. Your owner's equity account, capital, will increase on the credit side. For each business transaction, they have to balance, meaning the total amount debited must always equal the total amount that was credited. Let's try another one. Next transaction, we issued a check to purchase a computer and other equipment. Again, first thing you ask yourself, which accounts are involved in each of these business transactions? For this transaction, it involves the equipment account as well as the cash account. Now, you want to again ask yourself, did the accounts increase or decrease? The equipment account increase, whereas the cash account is going to decrease. Next, identify what are the account classification. For this illustration, these are both asset accounts. Okay? Now apply the rules of debits and credit. Therefore, the equipment account, we're going to debit because it is an asset account and it's increasing. Assets increase on the debit side. We're going to credit the cash account for $5,000 because assets decrease on the credit side. Okay? So we're going to stop this first video and come back with a second video recording some additional types of business transactions.